Hi there. So today we'll be talking about bridging finance, and in detail we'll be talking about and really focusing on non-regulated bridging loans. So these loans are not covered by the Financial Conduct Authority, the FCA, and people, property developers, property investors, they use bridging loans as a facility, to help purchase properties, raise money on properties. Ultimately, with a goal to making money from property. So it is a business venture. So we'll be going through today, why use bridging finance, how the monthly payment strategy is. So we refer to this as rolled up payments or service payments. So we'll go into detail about what that is. We're talking about sort of the refurbishment classification. So we call this light works or heavy works to a property. So what does that mean exactly in detail? We'll go through some examples of bridging finance, one with rolled monthly payments and one with serviced monthly payments. You can see clearly the difference between the two. And we'll be talking about why exit strategy is so key, and any additional consideration points as well. So the first thing is why do we see people use bridging finance? So one of the main reasons is speed. So let's just say, for example, you've bought a property at auction and you need to complete within 28 days, which is a traditional property auction. Now, a traditional mortgage will generally not be able to go through in that time frame. So therefore, bridging finance is suited and will be able to help you complete on the transaction within that time period. So that's certainly an example there. Let's say, for example, another situation where you're selling a property and you're buying a new one, but your buyer has pulled out of the property you're selling. So therefore, you're short of money to complete on the purchase. Or bridging finance could maybe step in and be a solution for yourself. So you therefore can complete on the purchase while you're selling your property still. Another reason for bridging finance is a property is in, say, poor condition. So we know this as uninhabitable properties. So let's say properties that have got no kitchen, no bathroom, a lot of damp issues, etc., needs complete renovation. These type of properties, you can't normally get a standard mortgage on, but a bridging lender would be happy to provide funds to allow you to purchase the property and make the renovations that are needed. Another example of a bridging loan being useful is buying a property that's got a short-term lease on it. So let's just say, for example, you want to buy a flat that's maybe only got 40 years left on the lease. Bridging finance would allow you to buy that property. And generally what the idea would be is you'd buy the property, then you'd negotiate with the freeholder to extend the lease. Let's say, for example, you get the lease extended to 100 years, and there's probably a cost involved for that as well. And then once you actually have got a long-term lease in place, it then would become available to more traditional types of lending. And another reason for bridging finance is extensive renovations are needed. So let's just say, for example, you want to buy a commercial property with the intention of converting that into residential accommodation, flats, for example. You may want to take a house and convert that into a HMO type property where there's multiple tenants living within the property. So again, when you're making these sort of quite extensive renovations, bridging finance lenders are more than happy to support you in them. Let's just focus now on the payment strategy. So the most common one we see is where the monthly interest payments are rolled up into the loan. So with this type of borrowing, you typically get a bit less money day one from the lender because the monthly interest every month is added into the loan itself. So we call this being rolled up into the loan. So every month a payment is due, but you don't make the payment. It's actually added into the loan. So the borrowing amount, the debt you have, increases every month. And then when you actually do go to pay off the debt, let's say, for example, you're going to sell the property, you then pay off the total debt that you owe. So that will be the debt you owe will be the amount you initially borrowed plus the fees plus all the interest that's been rolled up into the loan. You'll pay that off on completion. So that's where you roll up the monthly payments. The other option is if you want to service the monthly payments yourself. So, a monthly payment is due every month, and you make that payment yourself. So, in a sense, the debt itself that you're borrowing does not increase because you're paying the interest every month. Now, if you do choose to go down that route and make the monthly payments yourself, we have to do a bit more due diligence on that just to make sure that it is affordable. So we do a full income and a expenditure assessment to make sure you actually can afford, to make these monthly payments. But say we commonly see property developers opt in for the monthly payments to be rolled into the loan, and they pay the debt off on completion or on final redemption when they actually redeem the loan completely. So let's just touch upon now the type of works that we see. So, we see light refurbishment is one area. That is typically where you see sort of decorative cosmetic works being done to a property, such as, let's say you're going to get a new kitchen, a new bathroom, a replaster, new windows. That would all come under light refurbishment. And heavy refurbishment is typically more structural works. So let's say loft conversions, a back and a side extension, property conversions such as splitting a house into flats. That would all come under heavy refurbishment. Now, why does it matter? So ultimately, heavy refurbishment products will have a higher interest rate when compared to light refurbishment products. So it does have an impact on the interest rate that you'll be charged for borrowing the money. So let's now just work through an example of where you're looking to buy a property and the monthly payments are going to be rolled into the loan. So let's just say you've got a purchase price of £350,000. And in this example here, the lender will give you day one net 67% of the property value. So that's an amount of £234,368. Okay. There are lender arrangement fees, just over £5,000. We've got an example interest rate here of 0.89% per month. And so that interest is being rolled into the loan. We've also got lender legal fees here of £900 added into the loan. And we're going to take the example of over a 12-month period. So ultimately, in this situation, you're going to get lent to yourself 67% of the property value. So therefore, you need to put down a deposit of 33%. And the amount you're getting net day one, you've then got all the fees being added to that, and you've got the monthly interest payment as well being added to that. So if you did keep it for the full 12 months, the total gross loan that you would owe at the end of 12 months is £267,750, which is 76.5% of the initial purchase price. So that is an example there of what you would get day one with this type of bridging loan, with the monthly payments being rolled into the loan, and what the debt would roughly be at the end of 12 months. So, but one of the things I would say with a lot of bridging loans is that as much as you have like a 12-month term, it may well be that you actually only need money for, say, 6 months. It may well be you buy a property, you can do a refurbishment on that property, and you get it straight on the market. And maybe, all being well, after 6 months, you can redeem this loan. So with a lot of them, there's no early redemption fee is payable. So just to give you an example here, like if you was to borrow, in this example here, £234,368 day one. If you was to borrow that figure day one and look to redeem the loan after 6 months, I would estimate you would owe around about £253,361, around that sort of figure, because you've only paid interest for the 6 months you've actually had the loan for. So let's now just compare this to a second example, but this time is actually where you're going to be making the monthly payments yourself. So this is you're servicing the payments per month. So the purchase price again is $350, but in this example, the amount of money the lender will give you day one is actually 75% of the property value. So in this example, it's £261,376. So between the two examples, as the monthly payment, you're going to be making those payments, you're actually going to get an extra just over £27,000 day one from the lender. Now, also, you have got the lender's arrangement fees are going to be added to the loan. You've also got the lender legal fees are going to be added to the loan as well. And if you're getting charged an interest rate, an example rate of 0.89% per month, which is monthly payments about £2,382 a month, because you're making that monthly payment every month, the debt is not increasing. So, let's just say, for example, if you did have that loan for a period of just 6 months, or if you had it for 12 months, the estimated redemption figure would be around about £267,750. So this is basically the amount of money you're getting day one, which is the net amount you're getting to start off with. And then you've got the lender fees on top of that. You've also got the legal fees. Plus, I've added in a few sort of admin fees and telegraphic transfer fees as well. But as you can see, in this example here, you're getting a lot more day one, but that's because you're making the monthly payments on it and the debt is not increasing. So that's there just give you an example between the two, whether the payments are being added and rolled into the loan or whether you're making the monthly payment yourself. Now, I just want to mention here as well, there are additional fees payable. So you've got valuation fees, they will be payable, payable up front. You've also got legal fees as well. This is your own legal fees, and any sort of broker application fees, etc., might be charged as well. Now, it's another point to mention here as well is, let's just say, for example, you've got a property you're looking to buy, refurbish, and then sell. Possibly, you might have the money yourself to put together towards the deposit, but maybe you need help with the actual refurbishment cost as well. So depending on the scheme, depending on how much work needs to be done and what the final sale value would be, there's a possibility that a lender could possibly give you up to 100% of the refurbishment costs as well. Now, these are paid generally, these are paid in stages and in arrears. Okay, so I just thought I'd mention that as well, because that can be a real handy facility for some people on the right projects. So just want to talk to you now about exit strategy. So it's important that before any applications are made, that you're very confident in the exit strategy for the bridging loan. And I would be sort of asking yourself, just to sort of cover off these points, what if the final end value is less than you estimate now? If it was downvalued a bit, does the whole transaction still work for you? Generally with a bridging loan, you want to finish the property, get it done, get it on the market, get it sold quickly. So if you don't quite reach the final end value that you want, and it is a bit less than that, how would that impact the figures? Does it still work as a viable transaction overall? And if you are looking to, take the property and then go it on and move it on to like a buy to let mortgage, I would just throw a few questions to yourself. What if the final value is less than initially estimated? What if the rental income comes in a bit less? What if the interest rates do increase a bit? Will it still work? Just sort of run through some examples in your head to make sure the figures do work. A bit of a contingency, I suppose, really, just to make sure you cover all the bases, really. So that's certainly key, and we'd go through a lot of information with you on that. Additional considerations. The first point here is around tax advice. You can purchase a property in your sole name as a limited company, an LLP as well. The key here is that you get tax advice from a tax advisor. We say to everyone, before you go for any application, go get the tax advice. Make sure you purchase any asset in the most suitable structure for yourself that suits your situation. So get property tax advice. That's really important. Secondly, it's worth noting here that most lenders will want personal guarantees from yourself. So just be aware of that they will be required. There can be situations where maybe personal guarantees would not be needed for the full amount or not needed, but that's in situations depending upon your experience, the project itself, how much you're borrowing, also how much you're borrowing versus the actual property value, etc. But in most cases, most lenders will want personal guarantees. And finally here, your solicitor, your conveyancer, it's certainly worth working with someone in that area who has had previous experience in dealing with bridging loan cases. Okay, so because you have to be really on the front foot with these type of transactions, because normally there's a time deadline to work towards, and it's important that everyone's really sort of proactive. So yeah, so just sort of bear those additional points in play really. But say I just wanted to sort of go through this sort of presentation with yourself, hopefully give you a bit more information about bridging loans, and I hope that's been helpful. And I'll see you in the next episode. Thank you.